Welcome to Way to Commerce. Subscribe to Way to Commerce. Today we discuss about standard costing and variance analysis. A detailed introduction for standard costing. Our main objective is conceptual learning. First of all, standard cost. As per CMA definition, standard cost is the predetermined cost. Standard cost is the predetermined cost based on the technical estimates for materials, labor and overhead for a selected period of time for a prescribed set of working conditions. What is the standard cost? Standard cost is a predetermined cost. It is based on the technical estimates for material, labor and overhead for a selected period of time for a prescribed set of working conditions. So it is the standard cost. Standard costing, CMA defines the preparation of standard cost and applying them to measure the variations from the actual cost and analyzing the causes of variations with a view to maintain maximum efficiency of the operations so that any remedial action may be taken immediately. So standard costing means the preparation of standard cost earlier discussed and applying them to measure the variations between the predetermined rate, that means standard rate and actual rate. So measure the variations from the actual cost and analyzing the causes. So also analyzing the causes of the variation with a view to maintain maximum efficiency of the operations. So ultimately to maintain maximum efficiency of the operations so that any remedial action may be taken to immediately. So this is the standard costing. Next, variance analysis. So first of all, discuss cost variance. What is the cost variance? So cost variance is the difference between the standard cost and actual cost. Difference between the standard cost and the actual cost. For example, you want to buy a pen. Predeterminedly, we estimated for 10 rupees as per previous our estimation and actual results. Actually, it takes 15 rupees. In shop, the price is 15 rupees. So the difference is the variance. 5 rupees is the variance. So cost variance, the difference between the standard cost and the actual cost is the cost variance. Next, variance analysis. Here, variance analysis. Why the variance occurred? It is the analysis. Variance analysis is the resolution into constituent parts and the explanation of the variances, because it may be price variance, usage variance, mix variance, etc. So it is the variance analysis. The variance may be favorable and unfavorable variances. It is again classified as controllable variance and uncontrollable variance. Okay. So these are the all variances we have to discuss in detail. Types of variances in respect of material, in respect of labor, in respect of overhead and other variances. In respect of material cost variance, material price variance, material usage variance, material mix variance and material yield variance. So these are the material variances. In respect of labor cost variance, labor rate variance. In respect of material price, labor rate variance, labor efficiency variance. In respect of material, usage variance. In respect of labor, efficiency variance. Labor mix variance, idle time variance. So these are the labor variances. Next, overhead variances. Overhead cost variance, variable overhead variance, variable overhead efficiency variance, variable overhead expenditure variance, variable overhead fixed variance in respect of overhead variance. Other variances: calendar variance, sales value variance, sales price variance, sales volume variance, and profit variance. So these are the variances we have to discuss in further classes. Next, we have to know what is favorable variance and unfavorable variance. First of all, favorable variance. Favorable variance when actual costs are less than the budgeted cost, or actual sales or profit exceed budget. Okay, what is the favorable variance? In our earlier example, we predetermined rate how much? 10 rupees. Actually, the price of pen is 15 rupees. So is it a favorable variance or unfavorable variance? We estimated 10 rupees predetermined rate, actually 15 rupees, 5 rupees extra. So it is unfavorable variance. If the pen is only 9 rupees, the remaining 1 rupee is the favorable variance. So next, unfavorable variance. Unfavorable variance arises when actual cost exceed budgeted, or actual sales or profit are less than the budgeted. So when actual cost exceeds budgeted, it is unfavorable variance. That means actual cost is more. Okay, so here profit, revenue, cost. Actual cost greater than expected, then actual cost greater than expected. In respect of revenue, it is favorable because it is more. Actually, it is more, so favorable. In case of cost, favorable, unfavorable. Next, actual cost less than expected. In respect of profit, it is unfavorable. In respect of revenue, it is unfavorable. In respect of cost, it is favorable. Okay, once again I will tell you: profit, revenue, cost. So profit or revenue are the reverse. That means actual greater than expected. For example, we expected 10 lakh as profit or revenue. Actually, the revenue is 12 lakhs. So we happy or not? We happy because 2 lakhs excess. It is a favorable. Actual greater than expected, it is favorable variance in respect of profit and revenue. In respect of cost, it is unfavorable because we estimated cost as 5 lakhs. Actually, it takes 6 lakhs. Okay, so 1 lakh is the unfavorable. So this is the first one. Next, actual less than expected. In respect of profit, it is unfavorable. In respect of revenue, it is unfavorable. In respect of cost, it is favorable. Next, standard costs. So standard costs are based on carefully predetermined amounts. So how to estimate standard cost? Based upon predetermined amounts and used for planning labor, material and overhead requirements. We have to plan for material, labor, overhead requirements. Based upon that, standard cost estimated. Next, the expected level of performance. The expected level of performance. How much capacity of machineries we have, like etc. Next, benchmarks for measuring performance. Certain benchmarks are used for measuring performance. These are the standard cost. Next, setting standard cost. How to set standard cost? They set accountants, engineers, personnel administrators, and production managers combine efforts to set standards based on experience and expectations. So these are the setting standard cost. How to set? Accountants, engineers, personnel administrations, and production managers combine efforts to set standards based on their experience and expectations about the demand, supply, etc. Next, standards versus budgets. What is the difference between standard and budget? A standard is the expected cost for one unit. A standard is the expected cost for one unit. A budget is the expected cost for all units. So this is the main difference. So standard is the expected cost for one unit. Budget is the expected cost for all units. Next, in case of certain material price variance and material usage be computed if the quantity purchased is different from the quantity used. So how to compute if material quantity used is different from material purchase? How can we compute material price variance and material usage variance? In case of material price variance, compute it on the entire quantity purchased. In case of material quantity variance, compute only on the quantity used. So because here material price variance, so only we take material quantity purchased. In case of quantity variance, compute only on the quantity used. So this is the computation.